Achieving true diversification within an investment portfolio has become a more challenging task in recent times, as the economic textbook theories of portfolio diversification seem to have broken down in some instances, particularly during periods of market stress, which is a time when the benefits of diversification are needed most. It is no longer as easy as simply owning a portfolio of stocks and bonds, which has been the best combination historically due to the negative correlation, i.e., when equities are rising, bonds are falling, and vice versa. This is the foundation on which most portfolios are constructed, with the idea that a portfolio can benefit from a rising equity market whilst maintaining adequate protection generically from bonds. Having a well-diversified portfolio is as important as ever, but perhaps now is the time to look beyond a traditional equity versus fixed income split, and more towards diversifying within asset classes through different strategies, specifically environmental, social and governance, or ESG, focused strategies. Incorporating ESG criteria within an overall investment portfolio has become much easier in recent times. In fact, environmental, social and governance considerations have become firmly embedded into the investment processes of a large number of funds, with fund houses recognizing that although some investors may not want a dedicated ESG strategy, they still want the benefits that come with a thorough analysis of ESG risks and opportunities. It may not be about making oneself feel better as a person for investing in a socially responsible manner, it simply makes financial sense to do so, and ESG integration can be a great way to go about this. ESG integration often involves investors adjusting forecasted financials, such as revenue and operating costs, or company valuation models, including the discounted cash flow model, to account for the expected impact of ESG factors. Often, they will adopt an ESG scoring approach whereby assets are scored based on ESG performance, and those with scores below a threshold will not be considered for investment. It is therefore an enhancement to the investment process, which is not based on exclusionary principles, but focused more on mitigating sustainability risks and capturing opportunities from ESG trends. Whilst some funds may not use an explicit negative screen at the outset, certain sectors are naturally filtered out as a byproduct of this ESG scoring process, which tends to favour high-quality businesses with strong balance sheets, good corporate governance practices, and minimal negative environmental impact. Sectors such as oil and mining, alcohol, gambling, and tobacco are unlikely to qualify. This process of managing ESG risk is the key reason as to why combining investments which incorporate ESG factors into their analysis alongside traditional investments could improve the overall risk-return characteristics of an investment portfolio. The reason being is that ESG risk can be thought of as an independent source of risk, unlike other sources of risk. So by integrating that into your portfolio, you can reduce the idiosyncratic or unexplained risk, which is the purpose of portfolio diversification. Going a step further, for those investors who do wish to include dedicated ESG strategies within their investment portfolios, funds whereby responsible investing is central to the investment philosophy can be chosen. Again, these funds do not have to constitute an entire portfolio, but can be used alongside conventional investments in a blended approach which can deliver true diversification benefits. As the universe for ESG investments has grown, there are now sustainable options for the vast majority of asset classes, meaning investors are more easily able to build a well-diversified portfolio which incorporates pure ESG strategies. The benefits of diversification from combining ESG with non-ESG investments mainly stem from their different over- and underweights. This relates to many different characteristics, including style, market capitalization, and sector biases. For example, ESG and impact investments which employ positive and negative screens tend to have a bias towards growth companies, which are those that have the potential to outperform the overall market over time because of their earnings growth potential. By the very nature of ESG investing, companies tend to have this characteristic as they tend to be in the early stages of development, often with products and services which are providing the solutions to evolving environmental and social challenges. This is in contrast to companies considered as value investment which may have fallen out of favour and appear to be underpriced. Certain sectors may also be more prominent within an ESG-focused investment portfolio, including healthcare and information technology, while others may be underweighted, including energy, consumer staples, and materials. By combining investments which are biased in different ways, one can cover as many bases as possible, giving their investments the best chance at outperforming through various different market cycles, as certain characteristics are favoured for a time while others are out of favour, and vice versa, as the cycle continues. The ESG investment universe has also expanded to include several options for diversification on the non-equity side of a portfolio. Some of the key ways in which to invest ethically within fixed income include green and social bonds. Green bonds are bonds which are issued by corporations and more recently governments, which have their proceeds earmarked for putting towards specific climate-related or environmental projects. Similarly, social bonds are use of proceeds bonds, in which the proceeds are exclusively used to finance eligible social projects, including affordable basic infrastructure, affordable housing, and providing access to essential services like healthcare, education, and vocational training. The key takeaway is that ESG does not have to be an all-or-nothing approach. Rather, it is about assessing one's needs and wants and implementing the best strategy to meet these demands. By considering ESG strategies in combination with non-ESG strategies, investors are able to expand their toolkits and look further afield for the best investment opportunities available. A final way to look at ESG within the context of an overall investment portfolio is to focus on ESG as an essential risk mitigation tool. In the early days of ethical investing, which focused on applying strict negative screens which excluded large portions of the investment universe, it may have been argued that ethical investing increased risk due to the more concentrated investment universe. Ethical investing has come on leaps and bounds since then, and it is now more accurate to say that incorporating ESG considerations into one's investment decisions actually reduces risk. There are numerous risks to a business that neglects these environmental, social, and governance issues, including litigation risk, reputational risk, operational risk, and regulatory risk. Litigation risk is the risk that legal action will be taken because of a corporation's actions, inactions, products, services, or other events. For example, legal action may be taken against a company as a result of a worker safety incident or waste or pollution spill, which could result in a significant cost to the business. Reputational risk refers to the potential for negative publicity or public perception to have an adverse impact on a company's reputation, which could severely damage a business. A company's reputation may be impacted by poor labour practices or data breaches, for example, which could result in long-term damage. A business's overall operations may also be at risk of disruption as a result of poor ESG risk management, with examples ranging from weather-related supply chain disruptions to difficulty accessing the debt market due to high cost of financing. Finally, regulatory risk is one which has become more prominent in recent times as companies are beginning to face increased scrutiny not only from customers and investors, but also from governments and regulators over their ESG practices. As an example, forceful policy response to climate change is a key risk to polluting companies, as certain products or services could essentially become redundant through environmental regulations that may soon come into force. A company's failure to manage its ESG risks could have devastating effects on its long-term value. By employing an ESG lens to analyse a company, investors can better understand the risks and opportunities a company faces and the potential impact of ESG risk factors on the long-term business model. It is businesses that are best able to manage these ESG risks that will be most likely to fare better in testing times and will ultimately be best positioned for the future. The investment universe today is more vibrant and dynamic than ever, so creating a well-balanced portfolio with exposure to exciting and innovative products taking advantage of future trends in the market is now an easier task. By considering ESG factors when making investment decisions, whether through an integrated process or as a standalone investment, investors are able to align their investments with their own values, as well as allow the potential for better risk-adjusted performance. Although it may be a more time-consuming process in the short term due to the more in-depth analysis required, Undertaking this additional layer of analysis has proven to be key to delivering sustainable returns for one's investment portfolio, whilst protecting capital over the various market environments which investors have encountered in previous years and will continue to face in the years to come.